So the main thing that I want to talk about today is the possibility of a reignition of inflation. What needs to happen for us to get that outcome? Are we heading towards that outcome? And what does that outcome mean for equities and bonds? So let's start off with what we've been seeing lately. We got GDP today, which came in at 3%. We're seeing jobless claims continue to drop. I think we've had, what, eight prints in a row of dropping jobless claims. And we're not really seeing deflation really hitting anywhere. So, where do you see this going? Do you see this as a possibility where we get inflation reigniting?
Well, I think that that's a so when you say inflation reigniting, right? We have to address that we're talking about not inflation staying above target, right? Like if the Fed's target's 2%, I wouldn't consider inflation staying between 2 and 3 and not really getting, call it the high twos, 2.5 to 3, I should say. I wouldn't consider that like reigniting inflation. I would just consider that a decay in the disinflationary trend, right? I think reigniting inflation would essentially mean, if we take a look at the inflation numbers, reigniting inflation, in my opinion, would be inflation getting back above 3.5%, well above 3, I would say. Anything above 3 is likely a an
Yeah.
inflation reignition move, right?
Yeah,
So
I would
I
consider
think
it that. And I think the whole market would consider it that if that happens. I think we're going to see bonds completely reverse if that happened.
right. So where we are right now is pretty simple. The disinflation trend, I don't think is broken. I do think disinflation continues. I think if we take a look at the inflation nowcast for September, which we're going to get the official reading sometime next month is 2.25, and we're going to get PCE tomorrow for August is 2.3, and then the September estimate for PCE is 2.1. So if we take a look at where inflation is right now, 2 point basically 2.25 for headline, which is a quarter of a percentage point lower, and then PCE down as well. These are all disinflation signs that disinflation should continue. Could that change? Could we get a little bit of a hotter print than the estimated decline? Possible, meaning essentially inflation is not going to decelerate as much in the next reading. Perfectly possible, but again, that's completely different than the inflation reaccelerating and reigniting higher in terms of a rate of change basis. So one of the things that we can just look at real simple, and I posted about this on X this week, and this is like a good barometer for those that aren't following our models. Maybe that you guys aren't members yet, you haven't subscribed, you haven't taken the deep dive and opened up the world with our models, and you don't really know what's going on in terms of our regime system. Commodities are a great or I should say multi-signal tool or asset that you can look at, right? Because they have a price component for inflation, but also embedded with them, they're going to have a demand component, right? Like if no one's buying the commodity, or if there's a slowdown in demand, commodity prices fall. Therefore, when commodity prices fall fast or very consistently, there's usually a shock in the markets because there's this idea that not only is demand slowing, but price or inflation is slowing too. Therefore, growth and inflation are both slowing. That's a deflationary signal, which is typically one of the worst, one of the more negative signs that the market could pick up on it. So, if you're looking at commodities in your chart, you can type in GSG. It's the Goldman Sachs Commodities Index ETF. And if you draw a line of 22 and a line of 20, I believe at this point in the cycle, these are probably defining points either to the upside or the downside. So commodities range bound in this range between 22 and 20 on GSG is likely going to just facilitate this continued pricing and continued narrative of a soft landing where disinflation's continuing because commodities aren't really reaccelerating, right? And then you have this whole core service side of things that will provide further disinflation as the lagging rent component comes down. And we've spoken about that in the past. All in all, though, without commodities really accelerating, it's hard to make the excessive inflation case. So below 22, you kind of have this situation where inflation's not running away from you, and if growth is stable, you should get that soft landing price and continue. Now, on the downside, anything below 20, in my opinion, is going to reignite growth slowdown fears. So in this instance where we are right now, you're seeing everything kind of grind. It has been between this range for some time. Going forward is more important than where we were in the past. So if we commodities can stay range bound here, I think that soft landing pricing continues. Now, I would only really start throwing some wood on the inflation reigniting fire if we can get a sustained move above 22 on GSG. Then I'd be like, okay, we might have a problem here. And on the other hand, obviously, recession calls will get bolder and more pronounced if we can break below 20 and hold. We haven't been able to break below 20 at all over the last 12 months. So that's a very key sign here, in my opinion. Below 20, I think we can say that disinflation is actually accelerating and growth is decelerating. Therefore, the odds of sustained deflationary move in the market is much higher.
Yeah, and
But right now,
you can really see that in bonds, that low that commodities put in there almost coincided exactly with the top in bonds. Once, not the exact day, but pretty close. Once bonds realized, okay, this is not just a little bounce. This was actually a pretty decent bounce in commodities and in crude oil, and that's when bonds started to sell off. So I think if
yeah,
commodities
right
do
here.
head back down that way, which we are seeing, we can even, if you look at crude oil, especially, is already starting to reverse back down lower. We might get another reversal back up in bonds if this move continues.
Yeah. So if for those that are, again, maybe you're not looking at the models, you don't have access to them, or you haven't subscribed yet. This is some basic thing you can put on, a mobile chart wherever you want, just to keep an idea of what's going on. Commodities in this range will be a net good thing for the market. And depending now where growth is, if growth moderates, doesn't necessarily fall off a cliff, you will have the situation where bonds can rise as well. It'll be more of a slowdown bond move than a recession bond move. And we went over this again multiple times. Slowdowns are not recessions. Bonds do okay in slowdowns, they do really good in recessions. So if you're long bonds right now, a slowdown, maybe you're getting some there's some questions appearing now with GDP. Obviously, the last print revised up from 2.9 to 3. Current GDP now is sitting at around 3. So you're thinking, well, GDP is running just fine. But again, remember, there's more to the market than just the face value GDP print. Just because the GDP print is positive doesn't necessarily mean the market is pricing in on a forward basis a positive number, right? It's all about the strength of where growth is moving, not where it's been or not where it is right now. So if the slowdown pricing in the market continues to or at least persists right the way it has been, bonds can easily bounce up and maybe hit some new highs here. But a lot of people are looking for this mega bond move. And I think a good recent example is this type of move that we saw at the end of July, where TLT went from on a unadjusted basis, went from $92 to 100 in like a week or two, a week and a half. That is like more recessionary pricing. You're not going to get that type of move, that like a sustained move like that without a recession, which is why we're back to where, we were back in August on bonds at the moment. They're slowly going up, but they're not really accelerating higher. And I think a lot of people are looking for this type of move, a specific move in bonds that is more recessionary-esque than slowdown. Either way, though, like I said, slowdown and or recession is going to be supportive for bond prices, but recession is what is really going to ignite that move.
Yeah. Well, let's take a look at jobless claims. So that's The other argument for inflation reigniting is we're not seeing jobless claims move higher. It's been a while since we've seen it move higher. What does this
Yes.
mean? What is it telling us?
Yeah, so here's the continuing claims. Obviously, the reason why we even talk about continuing claims and jobless claims is because the unemployment rate is reported once a month, right? So at least we can get continuing claims 3, 4 times a month. The unemployment rate we're only going to get once, so we can kind of see what's going on here. And it looks like there's been some easing in labor. It's not as there was some of the tightening's been retraced here, and I think that there's a lot of reasons why this can happen. Um, and obviously it's a good sign. It's a net good sign. Like we just said earlier, right? With commodities bouncing, GSG bouncing since September 10th, and continuing claims falling pretty much the last couple of weeks. I think that's what's dampened some of this bond move that we've been seeing. But unemployment and labor, they shift rather slowly, and well, I don't want to say they shift slowly, but they shift with delay, and when they start moving rapidly, it's typically too late. So could this be just one of these things where we come up to like the 1.887 area, 1.87 million, consolidate, go sideways, and then something else happens and we go up to 1.92 million? It's possible, but right now we're on the downswing, and that's pretty good. But ultimately, this is all going to fall back onto the unemployment rate, right? That's what matters. And I spoke about this earlier this week in a note to our members. We drop a ledger note once a month. It's a note in the members area where members can kind of get a recap of what's happened over the last month, what the system is currently saying, and how it's shifted since the prior note. So it's kind of just like a little summary, giving you a better understanding of what's going on. And in the ledger note, I wrote how the maximum print for central tendency between 24 and 27. So basically, the upper end of the core Fed estimates for unemployment is 4.5. That's the maximum value. There is not a print higher than that in the last economic projections, which we got at the last FOMC. So this is where we are right now. We're right up against this wall, and all it takes is two, three, one strong print, and we're at it or even above it. So I think you have to look at it like this. Right now, if the unemployment print comes in lower next week, and we'll talk about it in the next podcast on what we think about that, where that's going. But ultimately, if it does come in lower, it's a good sign. But we're up against this 3-year high, forecasted high, and we have 3 years to go, right? So a lot can happen in the next 3 years. And the Fed is pricing their policy based on this anticipation that unemployment isn't even going to hit 5%. It's going to be range bound and chopped. Maybe they're right. Obviously, maybe they're wrong, right? We don't know. But I think the market is taking that guidance there, obviously, intuitively, in terms of like how it's looking forward. And we take a look at what the futures market's pricing in for the Fed, and we are still not breaking below the cycle low in terms of terminal rates. Like the lowest point in the cycle is still higher than where it was a couple weeks ago. So the market's not really scared. And I think going back to what we were saying earlier with commodities, I think some of this move or kind of hawkishness in policy expectations, meaning like the floor of policy being lifted, has to do with the fact that jobless claims have rolled over a little bit to the downside, which is a good thing, right? They've decreased. And then commodities have bounced a little bit. I think GSG under 20, you're going to start to see this floor drop again. I would just assume, right? Because I would assume that as soon as we start going, if you see any sign of continued or reappearance of growth issues, the floor is going to go down. And I'm not saying that it is the next likely, the next thing that's going to happen here, but keep an eye on it. Our models are looking into the future and updating in real time. We have seen some of the negative growth strength kind of alleviate over the last couple of weeks. So more of a bounce in risk on probabilities. I'm going to leave it at that, though. If you want to see what the model is triggering, you can go to the quant deck on the website. But let's go talk about Bitcoin.
Yeah, I actually was gonna say I think Bitcoin is another thing that you guys could look at in terms of determining whether we are headed towards a recession or if we're headed towards that growth rebound. Not necessarily a reignition in inflation, but a reignition in growth expectations. And I'm wondering if that's what Bitcoin is telling us. It just switched to neutral trend recently. A continuation in this move would definitely signal to me that there is a lot more weakening that needs to be done for us to really get that large bond recessionary trade that we're looking for.
Right. And I mean, ultimately, right? Like if the risk sentiment shifts, then our positioning is going to shift as well. Like we're not married to anything. Like we're not married to bonds. We're not married to anything in the portfolio. If the system merits a shift, it's going to happen. It's emotionless, right? So I think that you're right. If this does like the more this type of environment, so if you were to look back the last week, right? Say from Monday until till today, the more that this type of price action continues, the more unlikely that we are going to be facing a growth slowdown. I think that that's the best way to put it. In the last couple of weeks, last week and a half, we've seen growth expectations in the model bounce, and I think that the way the market's been reacting is reacting in a way that shows you basically what our model is saying, growth expectations taking a lift. And if that continues, then you get to the point where risk on becomes a possibility. I'm not going to say we're there just yet, but it definitely could be a possibility. Now, could this be a situation where we get another risk on before another risk off? And that's also a possibility where um, this idea that the Fed has held rates for too high and maybe they haven't held them long enough in the sense that the market's ready to, or the economy is ready to basically roll over. That's another possibility, but I don't think we're there yet quite yet either. I think we're more at the point where rates have been high. The Fed started the cutting cycle, and now the question is are they going to do another 50 basis points? Because we understand that they're behind the curve, right? And I'm sure you see the talk too on the internet, right? Like everyone's wondering if basically if this Fed is going to have to hold rates at a higher low than prior cycles, meaning the entire macro landscape has shifted, right? Post COVID.
Yeah, especially if we do get another risk on regime when they've only cut like 1%, let's say. That would definitely make me think that that neutral rate that they talk about is much higher than it used to be.
Right. And I think that that's pretty much where we have to take this, day by day. Like, obviously, I'd like to see bonds, right, accelerate higher from here. I think most people would understand why. But at the same time, it doesn't really matter what I want, right? Because if we could want whatever, it's a matter of what the market's going to give us. And the question here is it has to be at this point is, are you going to see enough underlying shift in growth strength to merit that risk on regime? Or are you going to be stuck in this muddy risk off, risk on environment where, like you said earlier, I don't think this entire discussion, by the way, is around inflation. We're strictly talking. I think disinflation is one of the more certain things at the moment, right? I think that's not really something that we need to worry about, like in terms of like we don't need to worry about inflation reaccelerating. In my opinion, it's more of is growth going to make the hurdle? Is it going to stay in a position where the market accepts it as advancing on an underlying basis, or is the market going to look at it and say, "Oh, okay, we're at 3, but maybe next print is going to be 2.5, right? And maybe the next print after that's going to be 2." Is the market going to pick up on a decelerating pricing curve, right? So that's where I think we're at the conjunction. That conjunction is either going to be expansion or deflation at this point in time, right?
Yeah.
We're seeing regime probabilities gyrate between or gravitate right from deflation towards expansion. but we're not really seeing it go to the right as in terms of like from deflation to stagflation or inflation. And I think that's a very important factor, right? So now where how far we are towards expansion, again, I'm not going to go into that, but you got to just understand that there's been a lift in risk on probabilities, but it's not necessarily risk on yet. And I think in terms of what's happening in the markets, we look at things like equities, right? Look at the Nasdaq, nice little run up the last couple of weeks, and you notice like the run up in equities and the fall and the drop in bonds almost matches what's been going on in commodities, right? Commodities bounce September 10th. Equities start ripping after September 10th, right? Bonds really top out after September 10th. Like, I think, again, for those that are just kind of want to take a simple approach, maybe you're not ready to become a member just yet. These two levels on commodities will do you good in terms of understanding what's going on. The lower commodities fall from here, in my opinion, is more of a sign that things are not as good as the market would like them to be. But anything in this corridor of 20 to 22 is going to yield the soft landing market environment where equities go up, bonds drift up. Maybe equities can outperform bonds. I think our system's going to pick up on that if that move is on the way. We're not quite there just yet. And then risk assets like Bitcoin should rise as well. We've been seeing that, right? Since September 10th. Again, look, September 10th, risk assets go up,
Yeah.
bonds,
It's
equity.
it's really not so much of a question of will inflation reignite? It's really a question of are we going to get a complete decay in growth, or is growth going to somehow keep up and we do get that more of a soft landing scenario instead of a recession scenario? That's kind of what I'm seeing with the way bonds reacted, how they barely pulled back, while equities reversed pretty hard and came up pretty hard. And then now we're seeing Bitcoin move. Commodities also reversed, but not too much. It's really all pointing towards growth maintaining the stable growth that it's at, and inflation just kind of continuing its way back to 2%. So I think anyone that's hung up on that inflation reigniting scare, and that's basically just like some bear porn that's floating around there, people trying to scare everyone, that's really the furthest outcome at the moment. There's a lot of pieces that need to go into place before that happens, and it's not like it happens overnight. That's something that if you do see that happening, you pick up on it and you can position accordingly before it actually fully materializes. It's not something that materializes overnight.
Yeah, and I think that you brought up a good point there, right? So, um, in terms of the soft landing being the most likely outcome at the moment, right? And yeah, I think that we're still in the in the stage three of our compound landing model. Put shortly, we're not at we're in the slowdown phase. Some could argue that we're lifting out of the slowdown now. There's some case there, but I think the ultimate overlay to what's going on here is this, right? If you have to first come to you have to take the stance, is the Fed restrictive or is the Fed not restrictive, right? And I think if for us, we obviously understand that, and our thesis has been the Fed is restrictive, and I know there's a lot of counter arguments to that and or counter takes or whatever to that thesis, but I do think the Fed is restrictive. So if we can establish that at the start, right? And we're going to talk only on the Fed being restrictive here. So if the Fed is in fact restrictive, and the market continues to play this soft landing game where it's pricing in or continues to support growth and disinflation, right? Positive growth and disinflation, or essentially inflation moving towards 2%. I think what's going to end up happening is you're going to start to see at some point the market go a little too far, where if this, the soft landing becomes almost easy, right? And by the market pricing in the soft landing, it's essentially having to add, or it's going to have to add restrictiveness to the market by doing it, right? Because what's going to happen is I know that sounds a little convoluted, but think of it like this, right? If commodities hold up and disinflation is continuing, but at a slower pace, it slows, right? It doesn't, because if disinflation continues at the pace it's been going, we're going to be below 2%, and we're going to actually overshoot the inflation target. That would also not, that wouldn't be a sign of things really deteriorating, and obviously that's not what a soft landing would look like, right? So disinflation has to slow with growth staying positive. And I think if this continues, you're going to get that situation where disinflation slows, growth may stay positive. And if we take a look at the Fed, the forward Fed curve in terms of what the market's implying, you're already seeing it lift a little bit, right? Like as the equities rallied and risk assets rallied, commodities rallied, and bonds kind of stalled, that this bounced, right? So the idea, and you could say the last 2 weeks were, or week and a half, were more soft landing esque, right? So if the soft landing pricing continues in the market, I think you're going to see the floor of policy lift, right? And this is where the dilemma comes in, because if the floor of policy continues to lift, because there's this idea that the neutral rate is in fact higher, and therefore the Fed doesn't need to cut as much to stabilize the economy. Well, if that theory is wrong and the Fed is actually currently very restrictive, and that floor and that policy floor is not where it should be, meaning it should be lower because the neutral rate hasn't significantly moved. What's going to happen is, by the market continuing to price in a soft landing, it's only going to add more restriction to the economy that theoretically is already being restricted. So it's almost like a compounding effect, right? Because as the economy tries to normalize, because everyone's seeing normalization effects, meaning maybe commodities not breaking down, equity prices holding up, inflation moderating, right? And the Fed only peaked in policy in late 22, so we've been a little over almost 2 years now at in the fives. We're back below 5, right? But this idea that the Fed is currently restrictive, if that holds, what's going to happen is the floor is going to continually rise higher, because this idea of the Fed having to cut aggressively to moderate the economy goes out the window, because the neutral rate and base rate goes up, right? And I think that is probably the dilemma that we have on hand right now. And to simplify that into a sentence, the longer the soft landing pricing goes on, the more restriction gets compounded back into the economy. So if that's the case, well, you basically have to ask yourself, is this sustainable, right? And I think that's the question everyone needs to ask, and everyone probably is wondering, is the current policy path where the Fed bottoms policy out at 2.8% in the next 2.5 years, is that good enough? And I feel like with unemployment where it is, right up again, we're literally up near the upper end of the range here of where the Fed expects unemployment to go over the next 3 years. I think it's a pretty bold statement at this point to say the soft landing is secured. I know a lot of people are going to claim that, though, but I just think it's a bold statement. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at The Market Radar, or go to our website at market-radar.com.